Morning, everyone. Thank you, Mike, because that gives me an extra 2 minutes on the clock here as well, which is fantastic. So thank you to that, and thank you to JJ for being so pithy. So what do you need to be a successful investor? Well, this is my version of it. A plan, a style, an edge, patience, a feel for psychology. That's your own psychological strengths and weaknesses, as well as those of the market. A checklist, a margin of safety, and then hopefully a helpful conclusion at the end. A plan. Now, for those of you who are more experienced investors, bear with me just for a couple of seconds, but for novices, this is the most important thing of all to think about when you're thinking of putting capital to work in the financial markets, because you are putting capital at risk, and you need to know why you're doing it. So why are you putting money into the markets? JJ's come up with one brilliant answer already, which is that returns on cash in the bank are absolutely dreadful. So that is a perfectly good starting point, but in the end, you almost need to think about how much money do I need at the end, whether it's my pension, school fees, dream holiday, work back to what you've got now, how much you can afford to invest on a regular basis. That will then dictate your time horizon, your target return, and your appetite for risk. And I'm going to use the word risk an awful lot. I'm hoping I'm not going to steal all of Mike Boydell's lines, because I know he's talking about it this afternoon as well. But risk in an investment context is best defined as your ability to suffer a permanent loss on an investment position. Now, how can that loss come about? Well, yes, the security falls in price. Then you can either lose conviction or faith in your research and sell and lock in that loss, rendering it permanent, or you simply could have got something wrong or been unlucky, whereby something went wrong with the company and the fundamentals simply didn't work out and it will never recover. That is a big difference from share price or security price volatility, which prices will do. If you can come out the other side, volatility simply isn't a problem. If anything, it's something to be embraced if you get your hands to buy here and sell here. But loss, risk is best defined as loss, and permanent losses get very wearing very, very quickly. Now, once you have the answers to these questions, how much do I want to have at the end? How much am I able to invest in the meantime, and therefore what my annual target return is, and how much risk you're prepared to take in the meantime, that will quickly dictate how you start going about putting your money into the market. It will certainly help choose your style for you. We're focusing a lot on the word of investment today. I would personally view trading as a very, very different discipline, but for some people it works better. It's just a matter of how you go about it. It will certainly dictate whether you're a trader, looking for fairly quick bucks on a short-term basis, or an investor looking to put money to work on a 3, 5, 10, 30, 40-year time horizon. And within that trading school, or the investing school, it may lead you towards certain styles, income, growth, for example. It will certainly help steer you towards the optimal asset classes for you. If in theory you're quite risk averse and happy to accept low returns, fixed income, cash, property may be ideal for you. If you're looking for something a little bit more racy, then you'll be leaning more towards equity or commodities, for example. It will certainly help you choose the most suitable investments for you. And there can be lots of those to discuss. I'm going to talk mainly about vanilla equity, but there's fixed income here today. We're going to be talking about we're going to be talking about exchange-traded funds and even some leverage products. And it will also help, with my AJ Bell hat on, perhaps you choose who the best service provider is for you, because certain platforms will be far better at providing you with certain services for certain asset classes and certain instruments and certain products. This is J. Paul Getty, a rich man, but when he earned that money getting oil out the ground, he was equally good at keeping it and indeed making it grow. So your style, will you want to be a trader? Again, fairly quick bucks, or will you want to be an investor looking to, patiently accumulate a nest egg over a period of time? And again, if you're an investor, we'll be looking to do that through buying growth stocks, through income generators, or a mix of the two. I would view trading as perhaps more the top. Speculation is the timing, the movement of money. Investing is converting time into money. And again, I think that's the difference between the two. Trading to a degree, looking at market momentum, looking at technicals, you're sort of guessing, well, where the money flow is going to go, this looks like it's going up, I'll have a few of those. There's nothing wrong with that, and actually it works for a lot of people. But if you're an investor, you're looking to do the latter. You're looking to let time work for you by investing in strong companies who generate cash and pay dividends. And it's the compounding of those dividends that really add up, as I'll show in a minute. And this is perhaps the most important thing to remember for any shareholder, is this bottom quote. Stock certificates are deeds of ownership, not betting slips. The word shareholder means you actually own the assets of the company, according to the percentage of the equity that you own. The professional investor is not impatient, not in a great hurry. He's an investor, not a speculator or a gambler. So the most important decision once you've decided to look at equities is if you are going to be an investor, you need to be investing in assets which you think have got something special about them because you own them. There's no point in investing in them if you think that they're no good. Now, there's obviously lots and lots of people out there trying to do this, and one of the things I'll come back to in a second is market psychology. But just remember, all of you today, and as Mike said, you're all friends together, but in the end, if you, sir, buy security and it goes up in price, buy security from that gentleman and it goes up in price, you've profited, he hasn't. Yes, thumbs up, very sorry, sir. So yes, in the end, although we're all friends together, you are also competitors and rivals, at least up to a point. And in the end, when you buy any security, you are implicitly telling the market it is wrong about the price that you're currently paying, the valuation you're currently paying. Now, when you think about how many people are here today, how many hedge fund managers are sat at their desks 12 hours a day, 6 or 7 days a week even? How many professional fund managers are out there? That's quite a big call to make. Now, you shouldn't be frightened of making it because that's what it's all about. And if the market was entirely efficient, none of us would be able to make a profit. So the market is not efficient. Don't let anybody kid you otherwise with efficient market hypothesis because it's not true. Yet, the market's views must always be respected because there's a lot of smart people out there looking at this and they'll have spent an awful long time researching it. So if a share price chart goes from there to there and you're a buyer, I've no problem with that. You just need a jolly good reason why. And equally, if it's going from there to there and you're a seller, ditto. And you need to take a three-dimensional view of the stock. The one thing that most investors focus on is the top one, growth. Because it is, let's face it, vitally important, and as JJ suggested, there's not an awful lot of it about right now. Well, there certainly hasn't been for the last 6 years. So it's extremely highly prized. But in the end, what you're looking to try and think of is, this is the price of the security today. I think the market's wrong. Why is it going to be wrong is what you've then got to decide. And what's going to make the market come around to thinking that you're right. And it's basically these three things. And I'm indebted to Michael Cahill, who was a former colleague from my investment banking days at UBS Warburg, and his book, because this is the framework that he uses, and he kindly lets us use it. We were hoping he'd be here today, but he's on holiday. So this is his framework, the growth, risk, and quality framework. And a lot of companies and a lot of analysts and commentators will focus on the top one, growth, and yet it's vitally important. For the shares to go up, it's possible that the growth will be better than the market expects. If you're a bear of the stock, you will be believing that the growth will be lower than the market expects. But growth isn't everything. Fred Goodwin grew the Royal Bank of Scotland. Yeah? No, he did. No, the bank went from being a small provincial bank to being absolutely enormous. But he then blew it up in the process because the risks he took to grow it and the quality of the earnings that he generated were poor. Well, the risks were high, the quality was poor. Royal Bank of Scotland was effectively an investment trust of banks because they were never properly integrated. So, growth is fine, but it's how you go about it and how sustainable and visible it is that really, really matters. Risk, again, this magic word. There are a lot, I mean, if you read Howard Marks, who's coming up in a minute, has just written one of his quarterly letters to shareholders from Oak Tree Capital, and you can download them for free. He lists 24 types of investment risk in his newsletter this quarter, and he says, I haven't listed all of them by any means, but it's absolutely fundamental. The three main ones, the company's operations, the company's financials, i.e. its balance sheet, which is in the end is the one that always gets you if you get something wrong, and market risk. As JJ said, we had a very, very nasty bear market 6 years ago, and good quality company share prices went down just as much as bad quality ones. So will the risks be less or higher than expected? You know, it doesn't have to be growth that gets a share price going. If you look at a firm like, say, Finsbury Foods, it made a big disposal, paid down its debts, and the share price roofed it. It sells ingredients for bread and cakes. It's not growing quickly, but the fact is the balance sheet went from being quite weak to actually really quite strong, and the share price rocketed. So there was no growth there. There was a massive diminution of risk. Quality. How do you define quality, visibility, predictability, and ultimately cash? Most companies, with certain honourable exceptions like the London Stock Exchange, have probably got 40 or 50-year time horizons, lifespans. They're going to throw out so much cash over that time period. And in the end, the only way you can really define its value is looking at that cash and putting a valuation on it. And if it's very, very predictable cash, you'll pay more for it now than perhaps you would do otherwise. So earnings are great. Don't get me wrong, profits are important, but I know lots of companies who've been making lots and lots of profits who've gone bankrupt because they weren't actually generating any cash. And it's cash that pays the tax man, it's cash that pays the rent and the utility bills, and most importantly for you as owners of the assets, it's cash that the company pays dividends with at the end of the day to reward you for the risk that you're taking by entrusting your capital to that company to run. Cash. Remember, profits are a matter of opinion, cash is a matter of fact. It is possible to pull the wool over auditors' eyes. I'm not saying that all companies do it. On the contrary, most companies, in the end, this is a fairly highly regulated market and a very visible and very transparent one. But there is the odd rogue out there, so you've got to be careful. And in the end, the key to investing is not assessing how much an industry will affect society. I would suggest that one that favourably helps society along will be doing something right, but rather determining the competitive advantage of any given company and above all the durability of that advantage. Now, if a company is making fantastic profits, three things can happen to it. More competition turns up, thinking, well, this is fantastic, we'll have a slice of that, thank you very much. Something can be rendered obsolete by a new technological development. Look at, say, the way that the smartphone has completely demolished the old voice-only mobile phone, or the way in which the tablet computer is eating away at the notebook and desktop computer. Or the regulator can just get extremely hacked off and decide you're making far too much money, I can't do anything, the customers can't do anything about it, the competitors can't do anything about it, so I will. Utilities, drug companies, financial services companies are all three examples of that. So it's actually very, very hard for a company to maintain a durable advantage over that 30, 40, 50-year period. But it can be done. London Stock Exchange, Coca-Cola, for example, are just two names that you can think of that you think, actually, I know exactly what they stand for, they do things rather well, and I'm prepared to pay for their services. And that is what competitive advantage is ultimately all about. People going to a company saying, I'm prepared to pay the price for the product or service that you demand because it's important to me to be able to do that. And that's a real competitive advantage, and that's what you want to be investing in as a shareholder. Patience. I've mentioned cash. Now, in the end, in return for taking the agency risk involved in giving money to a company, which is what you're doing, you're giving money to the management team to run, you need a reward at the end of that to say thank you. And the biggest reward of all is a dividend. Your share of that company's cash flow. Three lines here. The bottom one, the dark blue one, is the FTSE All Share since, the pale blue one is the cash. Easy peasy. So you've got this line here is cash since 1962. The average interest rate, by the way, has been 7%. Go figure, that sounds like science fiction now, doesn't it? This is the FTSE All Share compounded at about 7% a year, but without dividends. The curved line at the top is the FTSE All Share 7.1% a year, plus the average 3.8% dividend yield reinvested back in the shares that paid them in the first place. Okay, the difference doesn't appear to be very big for about 20 years, but then after that, you're completely off to the races. Now, if you think about it, all of you people in here who are investing for your pension, you're investing on a 30 to 50-year time horizon. It's not rocket science. It is about, capital growth is lovely, don't get me wrong, but it is in the end about banking those dividends, and the way you're going to bank those dividends is invest in companies with competitive advantages that last, so they can turn that into cash and turn that into your dividends. I keep mentioning Buffett, but just to prove that he's not an old windbag, this is his share price of his holding company Berkshire Hathaway. And this is the S&P 500 rebased against it since 1976. During this period, the S&P 500 has gone from 66 to 2,000. Berkshire's just absolutely wiped the floor with it using the simple discipline that we've just talked about now. Now, as Mike said, I work for AJ Bell, or an investment platform provider. We'll be happy to see you outside and happily take your commission from you for any trades that you put through us. But, as Buffett said, the fourth law of physics, according to Newton, should have been, for investors as a whole, returns decrease as motion increases. JJ is absolutely right. Liquidity is vital. We want you to be able to access and trade and buy stock in an efficient manner at a competitive price on a low spread. Doesn't mean you should do it every 5 minutes, because every time you do that, you're paying us £5. That's £5 in our pocket and £5 less in yours, and that'll compound up as well. Again, investors should remember that excitement and expenses are their enemy. Now, that previous chart wasn't very exciting, perhaps waiting around for 40 years, but it jolly was effective. And yes, the FTSE 100 over the last 15 years has been very exciting. 3,200, 7,000, 3,200, 7,000. But it was like riding a roller coaster, lots of palpitations at the end and no cash to show for it in capital gain terms. But again, if you'd banked your dividends, you'll have still beaten cash in the bank. This chap is called Howard Marks. I've referred to him once already. He's a successful fixed income hedge fund manager in the United States. He's big on market psychology. I've talked about the cold fundamental mathematics of studying good companies with strong operating models, strong balance sheets and good cash flow. In the end, I'm afraid to say that's not actually that hard to do. The tricky bit is working out what other people don't know. And Marx calls it first-level thinking and second-level thinking. Now again, we are to a degree, I'm afraid to say, competing with each other. The first part of any investment equation is this one, the one on the right. Outlook is favourable, shares go up. Nothing wrong with that. You've done your study, you've looked at the company, you've looked at its industry, you've looked at its competitive position. That's fine, but you can get that reading the Financial Times in about 15 seconds. So it's not going to do you much good in terms of telling the market something that it doesn't know and waiting for the market to follow in behind you. This is what you need to be sat thinking about. In a way without wishing to sound like Donald Rumsfeld, the known unknowns and the unknown unknowns. One of the most important things to know as an investor is you don't know it all. And what you're only, if anything, working out is the balance of probabilities of what might happen, which of those probabilities are priced in already and which are not, and of those that are not, which is most likely to happen. It's a very, very profound difference between that, and this is where you've got to go. So this gentleman here making his profit not only needs to know what he thinks about the stock, he needs to have a good idea what that gentleman thinks about the stock. The chart will go a long way to telling you that, and so will the valuation relative to the market. And then you need to think about the balance of the future, because in the end, something unexpected is going to happen. That's kind of just life. And then it's what you think the share price, how the share price will respond to that really matters. Psychology, now that will put you under sometimes a lot of psychological duress, particularly in a year like 2007-8 when it looked like the world was about to end, at least financially. So to try and help you stick to the disciplines that we've just outlined, have a checklist. Always refer to it. Stick to the plan. George Soros, one of the most successful investors ever, says he will take a position and then spend the next 3 months reading everything that disagrees with what he says. So there's no confirmation bias. It's very, very easy to think, oh, I've bought this stock, I'm going to read up all the stuff that says buy and ignore all the stuff that says sell. You should be reading all the stuff that says sell, because then you're stress testing your own theories and ignoring the stuff that says buy, because that's what you've come to already. This is Charlie Munger. He's Warren Buffett's sidekick. He has a checklist of 4 things. Do we understand the business? And if the answer is no, for God's sake, don't buy it. You'll feel very, very angry with yourself if you buy something that then goes wrong and you don't know why. Does the business have intrinsic value? Does it generate cash? Can you put a fair valuation on it? Does it have a durable competitive advantage? Management, lots of them out here today. Please meet them. Charming people, working hard, honest as the day is long, but you've got to make sure they do have integrity because they're looking after your money for you. Remember, if a management, Buffett says you want a management team to have integrity, industry, and energy. And if they don't have integrity, you don't want them to have the other 2. You want them to be dumb and lazy, because if there's no integrity and they're energetic and insidious, then they'll do you. And Enron, the guys made a big thing of just being the smartest people in the room. They didn't care about the business, they cared about being right, and that business eventually blew up. And again, does it come at a sensible valuation? It doesn't have to be dirt cheap, that helps, but a sensible valuation is very, very important. I won't go through these. These are 2 really good checklists. You'll have them in the slide pack. This is the holy grail for a company on the left. The really good things, if you get some of these that make a very strong company in a very long period of time. Again, note the emphasis on cash conversion, cash flow, strong balance sheet, and the ability to pay dividends. On the right-hand side, these are some of the things that will make your hair stand on end. They can go wrong. They can lead to things go wrong. They don't have to, but they certainly can. Dominant CEOs, frequency of acquisitions, unintelligible accounts, and again, weak balance sheet. Finally, valuation. This is Ben Graham. He was Warren Buffett's mentor. Operations for profit, i.e. investing, should be based on optimism. Should be based on not on optimism, but on arithmetic, i.e. do your cash flow calculations, look at valuation, and again, price is what you pay, but value is what you get. I know it's tempting to think that to get higher returns you have to take more risk. That isn't true. If higher risk investments guaranteed you a higher return, they wouldn't be higher risk investments, would they? No. Think about it. But if you do take a higher risk investment, at least make sure it's capable of generating higher returns by paying a low price for it. But just to prove you don't have to take more risk, say a drunk walks up to this gentleman, sorry to pick on you, in the pub, and offered to sell him a pound coin at 60p. Good deal, right? But the bloke comes back to you after another pint of beer and in 10 minutes' time offers you to sell it to you at 40p. You're taking less risk for a bigger return. That's the power of valuation. This is from Tim Price of PFP Group and a book called What Works on Wall Street. Again, just look at the slides. Everything at the top, high valuations, underperform the market on a 50-year view. Buying things on low price to sales, low price to book, low price to cash flow, low PE, high dividend yield, outperform the market on a 50-year view. There's nothing wrong with chasing value momentum as long as you pick your right time. But remember, ARM is a brilliant stock, but if you bought it at 10 quid in 1999, you've only just got your money back. It was the same company at 35p in 2003, then you made a killing. So it's the same company. Valuation is the ultimate arbiter of what your return actually is. So in conclusion, have a plan, keep calm, know your own psychological weaknesses and know the market psychological weaknesses, focus on competitive advantage, harvest those dividends, pay attention to valuation, and ultimately focus on cash, not profit. Cash can't be fiddled, profit can.